Evening, everybody. Can everyone hear me? Are we good? Gonna get a nod? You can hear me? All right. Hey, Alan, how are you? Great to see you. This is wonderful. We're gonna get started here in just a minute, admitting everybody. You know, we have over 300 people registered for tonight. That's amazing. So if you are not speaking, go ahead and mute your microphone. That would be much appreciated. Otherwise, we're gonna hear when your dog barks at the neighbor who rings the doorbell. So please do take a second to mute yourself. I probably can do that, but I'll have to figure it out. All right. Yeah, isn't that crazy? Over 300 people tonight. Everybody wants to hear Kathleen's economic update. And Lori and Keenan. Wow, this is super fun tonight. Got some new people to introduce you to, or a new person to introduce you to. We'll do that in a minute. All right, why don't we get started? It's 5 o'clock. And we've got nearly 60 people in the queue, so we will get going. Good evening, everybody. I'm Karen Hall, and SJREI is a group that I formed in 2012. So we're coming up, on our 8th anniversary. It's hard to believe. And for most of that time, Kathleen Kramer has done our economic update. And so that tonight is no exception. Kathleen is going to tell us all about what's going on in the world. Oh boy, I mean, there's just so much, right? We've got the Fed and the Department of Treasury and what happened in Oklahoma today. I don't know. But Kathleen, are you in a position to be able to do a screen share?
Sure. Thanks, Karen. I appreciate it. For those of you who haven't met me before, you may see my 11-year-old daughter poking her head up in the bottom of my screen. So watch carefully. Andy, please. So listen, thanks for joining us tonight. I'm the warm-up crew. I have about 20 minutes, so I don't know if I can cover the entire world and everything going on, but I'll do my best to give you kind of a 10,000-foot overview of what I see and some of the things that I've read and the blogs that I've been listening to, and share a lot of resources with you tonight. So I do have a presentation. I'm going to go ahead and share that with you now. And the slides will be available with a link that'll be emailed to you tomorrow. So don't feel like you need to frantically screen print because you'll have a link to all of these slides probably sometime midday tomorrow. But again, as Karen mentioned, I've been doing this for about 6 years now. I'll give you a little bit of my background. So I've been a real estate broker and a mortgage lender for going on 30 years now. I started in the mortgage side and funded about $1 billion worth of transactions, 2,500 or more. And, you know, it's a funny thing when you see everybody's tax returns, you start to realize that the people with the most income at retirement are the ones that have real estate. So I'm sure that's no mystery to the people that are on this call tonight, but I think that's really the reason we're all here, right? Is to build those passive income streams for the future, or have those Liberty events that we want, send a kid to college, buy a house for your kids, you know, go on that cruise, be able to walk away from your W-2 9-to-5 job, all of those kinds of life events and benchmarks. So I have had the pleasure of having some of those Liberty events in my life. And so I'm very excited about that, and I'm excited to share. So I am a real estate investor. I'm a broker, a lender. My husband and I have a company that invests in distressed real estate notes. So we buy distressed notes. That's what we do in real estate right now as our investing vehicle. There's so many different asset classes within real estate. It's just phenomenal. And I'm going to touch on how several of those are doing tonight and kind of try to give you my read on where are some of the opportunities going to lie in the next 6 to 12 months. So I'm a speaker, and I do have a degree in economics from UC Santa Barbara. So this is, a lot of people are talking about a V-shaped recovery. Well, this is the shape of my recovery, or this is my perception of the shape of the recovery. I think we're pretty much on a roller coaster ride. So I think as real estate investors, the good part for us is that we're not day traders, right? We're not trading stocks in the stock market. We're not buying gold. We're not, I mean, well, maybe you are, but that's not what this is about. So, you know, we don't revalue our assets on a daily basis, and that's probably a good thing in a COVID-19 or a black swan type of event environment. So we're going to talk a little bit about tonight about where we are in the cycle. What are some of the things that I think that you could be watching for, that I'm watching for? And to start with, there's a lot of data on this slide, so I'm going to unpack this for everybody. But I'm going to go in a clockwise fashion, and I'm going to start up here. If you can see, I'm going to try something a little different today. I'm going to try this little spotlight tool that they have, because we're going to get fancy. So right here, here's where I'm at right now. So this is just a snapshot of Orange County residential real estate market. And I subscribe to a service called Reports on Housing. We have data on a monthly basis. I've been a subscriber for about 10 years. And I'm also a real estate broker. So this comes from the MLS. This is not off-market transactions. This is on-market transactions. So I know a lot of you are seasoned investors, and you know that a lot of things happen off the market, but this is pulled right out of our MLS locally. So inventory a year ago was all the way up here. That orange line is 2019, and we were at 7,600 units, residential listings in Orange County, California. And today we're at 4,710. So we're down 38%. That's a very tight inventory for us. And you can see historically that we're typically running about 6,000 on an average year in the last 5 years here in Orange County. Then you come over and look at pending sales or demand, and you can see the V-shaped curve here, right? We talk about a V-shaped curve. Well, that's exactly what happened with our demand curve for transactions here. And we got down to 1,000 transactions pending in late April. And we're all the way back up to 3,000 transactions, almost 2,975 as of the end of the month. And over last year, curiously enough, we have 17% more transactions pending than we did a year ago. So we're rocking and rolling right now as compared to last year. And we're really, you know, on track. If we can hold and maintain this, which we may or may not, but if we can maintain this, we could end up with the rest of the curve looking a lot more like 2017. So, and the reason I say that is, if I can draw your attention down here to closings. So in May, we only had, in May of 2019, we had 2,900 closings. And in May of this year was our low point, and we were down 53% at 1,300 closings. So price to list was still holding steady. So we really haven't seen a huge discounting in the marketplace. I think what we have seen is we've seen an incredible drawdown on the market time. So look at these market times last year by market segment. So really, if you were under $1 million, your list to close was looking like 74 days. The percentage of demand in our market of $1 million and under is tremendous. 75% of our demand in Orange County is $1 million and under. So it wouldn't surprise me to see the median home price in Orange County decrease. Because why? What's the median? Well, the median is the middle, right? And if the majority of your transactions are happening at the bottom end of your scale, what happens to your median? It gets pulled down, right? So I don't think this is something to be scared about. I don't think that it means that your $2 million house is worth less. It just means that there's a lot more activity at the lower end of the spectrum. And that's where the inventory is too. So you're still seeing multiple offers. I talk to realtors in my marketplace all the time. I'm in Huntington Beach, but the same is true in Irvine and Newport Beach and Anaheim and all over, really. We're not seeing a lot of distress. 0.6% of the transactions were REO or short or distressed, and only 0.4 short sales. So 1% of transactions on market in Orange County were distressed of some sort. So we're really not seeing any kind of distress in the marketplace yet. So at any rate, and you can see that even at the top end, we do have a little bit of more inventory up there, but the market time has come down considerably in the last year. So, and this really has just happened in the last month. So it's been a huge transition. Perhaps some of those people that had to work downtown LA are coming to Orange County because now they can work from home and they don't need to make that 2 hour or hour and a half commute. So they're buying something down here in Orange County where we're a little bit more spread out and the quality of life is a little better than, than in Los Angeles County. And we have less restrictions in Orange County than they do in LA County. So perhaps some people are making that move, but that's basically what we're seeing there. So let me turn this off so I can forward my slide. So this is a chart that you may have seen before. It's a pretty common chart. This is a typical model of a recessionary cycle in the stock market. Now, this is not necessarily the housing market, but this is a really good illustration to talk about the diversity of opinions in the marketplace right now. So many economists believe that we're right here, what I'm going to call point A. And that is where we feel like some people call this the hope phase, the return to normal phase. But really what it is a trap because a lot of the economists that believe that we're here feel like we're not really going to have a V-shaped recovery. It's going to be a lot more of a roller coaster ride. And what we're going to see is we're going to see another dip, at least in the stock market and probably in the unemployment numbers. And certain segments of the real estate market are definitely going to have some distress in the next 12 to 24 months. So we're going to talk about where are those opportunities potentially and how you might be able to participate in that. Some people think the B class is trying, they either believe it or they're just trying to sell the narrative that we're already down here. So we did have a market correction in March. Remember, the stock market did correct. And some economic people are talking about, hedge fund managers and so forth, are talking about being down here where we're returning to the mean. I happen to be in the A camp, but that, everyone has to make up their own mind about that. If you want a little bit more input from the real estate perspective, there's a fantastic video on YouTube. Ken McElroy, he came out of the Rich Dad, Poor Dad, Kiyosaki group, and he does a fantastic 30-minute real estate distress cycle, market cycle talk. And I just have a screenshot of that here. But basically what you have are 5 phases. You have the liquidation phase, the hope phase, the insolvency phase, which I think we're transitioning right now from the hope phase to the insolvency phase, where we're going to start to see more defaults, especially starting in the commercial real estate, mortgage-backed securities and the CMBS, starting with those hotel properties, retail properties, perhaps getting into some apartment properties on the B and C class apartment units. Maybe some distress in the single family, but we'll have to talk about which market segment we may see that distress in. And then we see a deflation. So when you have a lot of bankruptcies, then the market wants to clear. Depending on government intervention, we may or may not see the market clear. More than likely, the government intervention will just draw it out. It'll make it last longer, maybe not go quite as deep. And you can make a value judgment about that, but I do see a 4th phase of stimulus coming probably in the fall before the election. And as soon as we start to see these PPP loans roll off and people start to hit the unemployment numbers, start to go back up again, my belief is Congress will come back and put phase 4 stimulus, some kind of helicopter money or MMT, whatever you want to call it, of some sort to try to stimulate the economy further. So still a long way to go, in my opinion. This is viewpoint B, or at least the narrative from viewpoint B. And of course, this is James Powell, or Jerome Powell, who is the head of our Fed. And they made a policy statement in June. They're going to meet again here later this month. and they took the Fed funds rate from a quarter to a half down to 0 to a quarter in a range. And they also said, hey, we don't really anticipate any rate hikes for the next 2 years. So, but look at where they're anticipating. Here, I'm going to turn this on again. Look what they're anticipating as a year end. So they think we're going to end the year at a 9.3 unemployment rate and a negative 6.5 GDP. That'd be an annualized GDP with very little inflation. So that is what the Fed is predicting at this point. I think that's pretty ambitious. I think it's a little bit optimistic. And I think it's going to be a little bit more of a bumpy roller coaster ride between here and there. So, and then you can kind of see where they think we're going to be all the way back to +5 GDP next year. I hope they're right, but I doubt it. So we'll see. Here's where we are right now. And this is, if you've never seen this before, this is called GDP Nowcast. This is part of the Atlanta Fed. You can go to gdpnow.com and here's the URL actually, and you can find this slide. What they do is they actually start with an opinion of where they think GDP is going to be for the quarter, and they give you the date that they make their first nowcast, they call it. And then as the different economic reports come out, they change their forecast in real life time. Whereas a lot of the blue chip consensus type folks, these are the banks and the hedge fund managers, and they tend to make one prediction for the quarter and then they stick with it. But the Atlanta Fed has this data group and they publish these numbers, and they pretty much every time an economic statistic comes out, they change their nowcast. And as of today, or as of the 3rd of July, they're predicting that second quarter GDP will be negative 35%. And just so happens that's where the consensus landed. But that's a long way from down, you know, what is this, probably down 10 right here, or down 11 to down 35. So I think that the last 6 weeks, if you will, the last 4 to 6 weeks, if you will, they've really been changing their tune a little bit about where they think things are going to go. And there's a few reasons for that. Here's the unemployment rate. So depending on who you ask and what city you're in, you could be anywhere from 13 to 19 million people unemployed. This is the current number. You can go to fred.stlouisfed.org and you can pull this chart up. You can measure it starting from any date. I put 2008, January 1st in my start date because I wanted you to be able to see where we were and how long it took for the unemployment to kick in the last recession. So we started to have issues right in the second half of 2008, right? In the last financial crisis. This is the recession right here. Unemployment peaked, and then the recession was over and the recovery kind of ensued from there, right? So what they're showing is a recession. See this teeny skinny little line? They're showing that as the recession currently because they're expecting the bounce back. But I happen to think that we're going to get a little bit more of a squiggly line here with the unemployment rate. You have people coming off of the PPP loans. So the first PPP loans, when they funded, then people were hired for 8 weeks. They later extended that to 24 weeks. However, most people were rehired on that 8-week paradigm. And then the businesses started to pay them based on that 8-week schedule, thinking they would have to do that in order to get their forgiveness. And so those 8 weeks are going to be up pretty soon. The other thing that we see happening at the end of July here is those $600 extra unemployment checks are going to stop. So the Fed, the IRS, or the federal government subsidy that was kicking in on top of the California or the other state unemployment is going to finish at the end of July here, unless we have another stimulus package. So a lot of uncertainty in the next few months here coming into the election cycle. Here's the labor force participation rate. Again, I took us all the way back to 2008, and you can see that we really continued to lose participation in the jobs market all the way until about 2016 is when it turned around. And then we started to see businesses really starting to hire again and pick up. People came out of the workforce, off of the sofa, if you will, and back into the workforce. So at any rate, we really have had a significant dip in that regard, and we'll have to keep an eye on that participation rate. Very interesting podcast today with Sean O'Toole and Aaron Norris, who's now with Property Radar. And interesting statistic that I thought was good to think about. So US has the highest level of manufacturing that we've ever recorded. So the GDP, or the output of our manufacturing, is the highest ever recorded, right now. However, we are only employing as many people in the manufacturing sector as we did in 1945. So 25% of that is from offshoring, and 75% of that is from technology. So I don't think we're going to be able to reverse the technological improvements. In fact, I think those will only accelerate. And I do think we will pick up some manufacturing volume, like GDP will pick up from manufacturing, but I don't think it's going to be a panacea as far as job headcount. So we really need to think about, where are these jobs going to come from? Hopefully our housing sector can hold steady, because we know retail is in trouble, and we know that hospitality is in trouble right now also. So we need to keep an eye on the participation rate. And we also need to keep an eye on, where are those jobs being created, at what income level, because as real estate investors, we need to know who our customers are. And for those of us with rental property, we know our customers are our tenants. And we need to understand who's essential, who's not essential, who's gotten laid off, who hasn't gotten laid off, and which jobs are likely to be lost to robotics or other types of things in the environment going forward. If you're interested in tracking unemployment by zip code, which, if you're a real estate investor and you're thinking, hey, I'm moving money out of California and I'm going to go to Georgia or Alabama or North Carolina or Florida, this is something I would definitely want to check out. So this is geofred.stlouisfed.org, and you can search by zip code, and it will drill down by zip code the unemployment rates for you. And then you can drill down unemployment rates by category, like hospitality, retail, manufacturing, healthcare. You can by income level. So I think, since income is such a huge portion, obviously, if our tenants can't afford to pay the rent, then that's going to really, hurt our investments. So I think this is an incredible tool that I would encourage you to check out. This is just a map of the US that I pulled up, and you can easily print these. You can download them. You can download the data. So lots of fun with this one for all of my data nerds out there. So the other thing we need to watch is credit availability. Now, the mortgages, the amount of applications for mortgages hit a high this week. So it's the highest that it's been since, 2012 or something like that, when the rates went back down. So, however, we still have this credit overhang with people in forbearance. And these numbers are a little old. You should go to blackknightinc.com. They will publish new numbers probably in a few days about how many loans are in forbearance and the share of loans in which kind of loan, Fannie, Freddie, FHA, VA. And then if you're flipping houses or you're thinking of flipping houses, you need to know, what kind of loan is my buyer going for? What kind of FICO score do they need in order to qualify? Because of the forbearance issues and the liquidity issues of the servicers having to cover some of these payments and some of the taxes and insurance impounds for people that aren't paying, if they go into forbearance and they have an impound account, the client, the borrower, doesn't have to pay their taxes or insurance impounds. So the servicer is having to fork that money up and put it out as an advance. So this is why a lot of banks and lending companies are getting more and more conservative. They want those higher FICO, lower LTV, stronger borrowers, bigger loan amounts. Loan amounts under $50,000 are tough. You know, even under 100,000 can be tough. Loan amounts over the Fannie Mae loan limit can be tough because the jumbo market is super tight. Alt A is super tight. So we really want to be thinking about, as investors, who are our customers? What kind of loan do they need to get? What kind of loan do I need to get as an investor for my next purchase? And then what is the availability of that credit that could be in our equation when we're looking at opportunities? Tenants paying rent. So another place that you should go or visit is NMHC. It's the National Multifamily Housing Coalition. They track 11.4 million units every month, and they track more than once a month. So, and the good news from here is that if you look at month over month, and these different striations here in the bar chart, they do a poll 4 times a month. So they ask on the 6th of the month, the 15th of the month, the 22nd of the month, and the end of the month. They will do a survey and find out how many people have paid their rent. So the first number is how many have paid on time by the, say, the 5th or the 6th, right? The 95.1% number in May is how many people paid by the end of the month, right? So at least they weren't 30 days late. And you can see that from May of 2019 to 2020, we're only off about 1.5%, which that's pretty encouraging, I think. Now, again, that unemployment subsidy is rolling off at the end of July. So really important to see what happens in August, right? Can those tenants make those rental payments in August, and how many of them have to ask for help? So we'll see. If you're a California investor and you want an update on all of the different regulations and restrictions, can I evict, can I not evict, when can I evict, you know, what do I have to do? I found a great resource, and it's down here, nolo.com. You know Nolo Press. A lot of investors know Nolo Press because they publish the legal books, handbooks. But they have a fantastic website that breaks down all of the national legislation and the California legislation, which it changes daily, right? Whatever the governor wants to do that day and extend it or what have you, and it can change on a dime. So this, I thought, was a fantastic resource for you investors out there who want to keep up with all those eviction bans and the tenant protections and so on and so forth, because it is changing day by day. I'm going to breeze through some of this a little faster. This would be a very important slide if you're interested in commercial purchasing, maybe distressed, either a loan or a property, because you can see where the distress is. So this is Moody Analytics and REIS, and they actually took a survey of the servicer comments. So let's say I have a hotel property and I can't make my mortgage payment, and I call my servicer to discuss options. Well, they're tracking that because the servicer makes a note, okay? So surfacing comments mentioning COVID. So a lot of artificial intelligence going here. But you can see really here how these are actually the ones in forbearance, the light blue. These are the ones COVID forbearance. So typical forbearance, COVID forbearance. So you can obviously see, as we might have suspected, that hotel and retail are doing poorly. Office is actually hanging in there. So that'll be an interesting category to watch going forward. And, you know, as some of these loans start to default, the Federal Reserve has made an agreement with BlackRock, to take these assets and create a facility similar to the RTC in the 70s, so when the SNLs went down. So interesting stuff. Where to find opportunities? So single family homes. I think that the thing that's different this time than last time in the single family environment, which gives me hope for the people that own single family homes, is they have a lot more equity this time than they did the last time around. Tons more. So this chart shows how many people own their home free and clear, 33.6. You can see 13.3 in the 60 to 99%. And you get down to less than 10% equity and under 20% equity, and you're really looking at just over 10% of the single family home owners have less than 20% equity. That's a very solid foundation for these folks to be sitting in. When you compile that with Fannie and Freddie and FHA and all the forbearance opportunities that the GSEs are offering, I believe that the GSEs, once they stop taking new forbearances, will come out with something similar to a HARP loan, like they did in 2010, to help those homeowners refinance. So let's say I had to get a silent second tacked on to the end of my mortgage for 1 year's worth of payments. They're going to offer those borrowers a refi. And I think if you have a certain amount of equity, you have a job, you know, you can fog the mirror. I don't think they're going to make it that tough, just like the HARP. There really were very few criteria. So I don't know how much we're going to see on an REO basis, but when these things might start showing up would be next April to June, based on the timetable of when all those forbearances kick in and when they will roll off, and when the unemployment rate might spike again. I think that if you look at those factors put together, my guess is somewhere in April to June of next year to start looking for these types of opportunities. So we'll see. Here's a whole list of places to go for data. Because I can't do all the due diligence and then present it to you in a 20 or 30-minute presentation. But what I can do is I can help you find those resources of where to go. There's no substitute for boots on the ground, so I know that it's tempting to buy that property looking at it first. But I still am in that camp that you've got to get on the plane, wear your mask, go look at the neighborhoods, get the feeling, meet the team, do the research. You know, it doesn't matter. I just don't think there's any substitute for that. So this is a list that you'll be able to look at on your own. This is just some dates, due dates on when I think that we might see some distress in the marketplace or when you could expect to take a look. So I mentioned the PPP loan runoff. That's when those subsidies end and the employers actually have to start paying their employees out of revenue again. The California courts, well, of course, that was just extended. So September 30th is the new date, but really we don't know when the new date is because it'll probably get extended again. Election results, I put an asterisk here because if you live in California and you're on this call, if you haven't already heard about the split tax roll initiative, you better look into it. Google it because you're going to want to know about that. Phase 4 of stimulus on the other side could draw things out further, make it a little bit longer of a period of distress. And again here, GSE, the forbearance defaults. So when the US government ends the state of emergency, then the borrowers will have 12 months from that date to have negotiated their deal with their bank. So right now they're in a forbearance holding pattern and they'll have 12 months. So whenever that end of that state of emergency is, which we don't know when that is yet, then give it 12 months and look at the calendar and then start looking for those distress situations. Between now and then, you're gonna have unemployment, divorces, bankruptcies, other kind of typical distress situations just accelerated due to the pandemic. But I'm talking more broad scale type of things. So there's deals to be had out there. There's a lot of deals to be had out there and probably some pretty good ones. So they're just out there. You just got to do a little digging. More resources, again, what to do now, study, learn, get into liquidity. So make friends with your liquidity and get ready for those next opportunities. So my name's Kathleen. I'm at kathleen@libertyre.net. Feel free to ping me if you have questions. You could put questions in the comments in the chat box. And if there's time at the end after Lori is done with her presentation, maybe we'll have a little bit of time for some Q&A. But for right now, we're going to get on to that great deal profile, Karen. And thank you so much. I really appreciate your time.
Thank you, Kathleen. Another stellar report. Just so appreciate you. Lori is up. Lori, are you able to unmute your mic there?
I believe so. Can you hear me?
I can hear you and see your pretty face. There you are. Good to see you.
Good to
Yes.
see you.
And here comes your screen. You know, I was looking at Lori's bio and it was like this long, you know. I had no idea that you'd done so many different things. I mean, just what have you not done? So just so honored to have you here tonight. Really excited. So I'll let you take it away, Lori. Thank you so much.
Thank you. Thank you, Karin. So I feel honored to be here. We had Karin up here at SJREI, I think it was last month or the month before. And so it's great to be here. My background is that I've been in real estate for well over 30 years. And one of the things that I learned is that I like to keep the money I earn. And so I spent a good amount of time working on finding tax strategies that would help me keep the money. And that's what I want to share a little bit with you tonight. And, you know, I'll provide information on how you can reach me afterwards. This is pretty high level, and there's a lot of information that I really can't go into the details here, but I am willing to have conversations with you on your individual needs, should you have any of those. So I do tell you here, you know, I am a real estate professional. I'm not a tax, legal, or investment consultant. So you need to make sure whatever I tell you, you seek your own professional help on that. So one of the things that I say is that it's not so much what you make that matters, it's what you keep that matters. And a lot of people don't realize how much of the effort that they put in is actually going to go towards paying taxes. So let's talk a little bit about how to figure out what you get to keep. Let's assume you have an asset that you're selling for $1.5 million and you pay off the loan, that's $500,000, you get to keep $1 million. But the reality is that might be the money that you get paid, but you still owe taxes on it, and that the government, they don't care what your loan was. They only want to know how much profit you made on that. So it gets a little more complicated than those simple numbers. The first thing you do is you sell the asset, and then you have to minus the agent and closing costs. Then you would minus whatever you purchased the property for. You get to add in any improvements that you've made, but then the government makes you recapture depreciation in order to calculate your gain. That's what you're going to pay taxes on, is your gain. But then you still have to pay off the debt, and usually you don't end up with a lot of money left over. So I'm going to explain some of my topics or some of my tactics here by going through a case study. And this case study is a client that I actually helped, apartment building. They owned it for 20 years. Now, on this apartment building, they were able to sell it for $6.5 million. And the cost of sale, meaning the agent and the closing costs, was about $400,000. So their net sales proceeds were $6.1 million. Their cost basis, and I rounded this up to make it easy numbers, was about $1 million. They had about $100,000 in improvements. And for the 20 years, they had taken depreciation of about $544,000. So as far as all of the taxing entities care, they have an adjusted basis of $556,000. That's how much they have into this property that is going to come off their net proceeds when they calculate the taxes. So if we subtract the 556 from the 6.1, they have a taxable gain of 5.544 million. Now here's where it gets fun. The first thing is the Fed comes in and takes theirs. Then the state comes in and takes their portion. And then we have the net income tax, which is 3.8%. That comes out. We have depreciation recapture, which is 25% of the depreciation. And so in total, on this gain, this client was going to pay 2.2, basically 2.2 million in taxes. That's 44% of their gain going away in taxes. I think that costs more than the garbage and all the other expenses they worked hard to keep low. And here the government didn't even help. So I want to talk a little bit about how you can legally shelter the tax gain. And I'm going to start very basic. So the first thing is a seller receives the buyer's money in exchange for an asset. The buyer receives the money, receives the asset in exchange for the money. But it's not actually the sale that triggers the taxable event. And this is a key point as to trying to tax plan your way out of paying a lot of taxes. It's not the sale that is the taxable event. It's constructive receipt. When you receive your sales proceeds, the taxes are due now. And that is the key word, is receiving your sales proceeds. As soon as you receive those, the taxes are due. And we just saw one case of a California seller that was going to face 44% of their gain going away in taxes. And it's not uncommon, even properties that are getting sold in Ohio, Tennessee, out of state, the taxpayers are seeing 30 to 40% of their gain going away towards taxes. And I just want to point out, a lot of people go, oh, well, we'll just pay it and be done with it. But let's say that you have a taxable gain of $1 million. That means that you could have a tax bill of $300,000. What if instead of giving that to the IRS and all the taxing entities, you took that $300,000 and you invested it in a secure fund where you were earning 8% interest compounding? Do you know that if you invested that in a safe, secure fund for 8% compounding for 30 years, that $300,000 will grow to $3 million? So the question is, do you want to take that money and have it grow, or do you want to pay the taxes now? Now, I know a lot of you might be thinking, well, I'll just do a 1031, and we'll talk about that in a minute. So let's talk about why 1031s work. So the seller releases the asset to the buyer, just like before. The buyer releases the money to the title company, but the sales proceeds never make it to the seller. The seller never receives those sales proceeds. So there is no constructive receipt. Those proceeds go to a third party. We have different names for the third party. It might be an accommodator, it might be a qualified intermediary, but the reality is they're going to a third party that is then given instructions on what to do with those proceeds on behalf of the seller. So it's good, we have no constructive receipt, but if you've ever done a 1031, you know that there's a lot of rules and regulations. First of all, if you pull out any cash, you have to pay taxes on it. So typically you don't get any cash from it. You have 45 days to identify a replacement property and 180 days to complete the purchase. Now with COVID going on, that's difficult, especially for people who had it. And so we got extensions on that. But the reality is that it is still a rushed purchase. I mean, having to identify a large apartment building that you might want to go into, like this particular client, in 45 days, they would have to pretty much go through LoopNet and identify everything in order to have enough time to do their due diligence. Another piece that people kind of forget about is the carryover basis. And I'll discuss that in a little bit, but that's actually a detriment to you. And then whenever you go into the new purchase, you have to have equal or increased leverage or debt. And a lot of the clients that I work with are trying to simplify, they're trying to sell their assets, and they don't want to take on any more debt. So there's two pieces that we pull together for this program to work. And this is a program that is a done for you program. You don't have to go out and figure all this out. and put all the players in place. I have all that done. If you want more information and you want me to help you with this, I can do it. But I'm going to give you a little bit of background on how it was developed and how it was created. So there's two pieces that we put into play. The first one is deferring the taxes. We defer the taxes using the IRS code M453. This is the installment sale reporting tax code. Now you think about it, if you sell a house to somebody, but you don't receive your sales proceeds. So they have the house, they're making interest-only payments to you, you did not receive your sales proceeds. Is that taxable? No, that's not taxable. We just talked about constructive receipt. So if you sell your house or you sell your property or your asset, it can be a business, it can be anything except publicly traded stock. So you can sell your car, anything. If you sell it on an installment sale and you are not a dealer, that's a key piece, you are only taxed on the sales proceeds that you receive. So if you sell it interest only, you're not receiving any sales proceeds, you have no tax due. So we construct a sale of your asset to be 30 years interest only. So there's no principal being paid. So there's no tax due for 30 years. That's how we defer the taxes. So not $1 of sales proceeds is paid for the first 30 years. So there's no constructive receipt. So we've deferred the taxes. Now the next step is, how do we get you a lump sum cash? Because you probably don't want monthly payments. You probably want money. And so what we've devised is a way to make a loan to you. Are loans taxable? If you go to the bank and you borrow money, are you taxed on the loans? No. So this is the second piece. First, we defer the taxes, then we get you cash in almost an equal amount of what you would have received in your sales proceeds, but it's written as a loan. And by being written as a loan, it is not taxable. So if we go back to our parties of the sale, we have our buyer. And here, the buyer's sales proceeds, essentially it goes to title company, it transfers to a party that we call our capital asset dealer. This person gets the proceeds. So let's just say it's $1 million sales proceeds. The capital asset dealer has that. Then a private lender, a completely separate entity, makes a no recourse, unsecured loan that is a business loan in an amount of 93.5% of your sales proceeds. So almost all of your sales proceeds comes to you in a lump sum loan. The next step is, if it's a loan, who's going to pay on it? I don't want to pay on a loan, right? You're trying to sell an asset, you don't want to pay on a loan. Don't let that clog your mind here, because the reality is you don't have to pay on it. The capital asset dealer who has those sales proceeds is investing those sales proceeds, getting a monthly amount, and paying on the loan for you. Every month, they pay on the loan for you. And remember, this loan is unsecured and no recourse. So if the capital asset dealer doesn't make a payment, they're not coming after you for a payment. They're not coming after you to get any of that money back. I know this might be a little bit wild, and you might be thinking, why would a lender do that? I'm going to get to all of the common questions when we get a little bit further in the presentation. So we set this up with automatic escrows. The dealer puts monthly payments into an installment escrow. The escrow instructions say to automatically transfer that to the funding escrow. The funding escrow instructions say automatically transfer that to the loan escrow. So what's happening is the monthly payment from the dealer is going to you, the seller, and then from you, the seller, automatically to the lender. This is done hassle-free, automatically, 360 months without anything from you. It gets done. So you don't have to worry about that money. You walk away, you invest it the way you want, you buy your asset, your next asset cash, and this gets taken care of for you. So how does the loan get paid back if the seller is not paying it? If you remember, on the right-hand side, the capital asset dealer received the sales proceeds. So they received the $1 million. They're going to put it in the stock market or some other investment where they know that they can get 8 to 12%. And then every month they're going to pay on the loan, which is only at 6%. So the capital asset dealer is making spread on the money, and the lender is getting a secure investment because they know who the capital asset dealer is, and they have given that capital asset dealer a charter of how to invest those funds. In 1980, Congress said that a seller could receive sales proceeds in connection with an installment contract and still receive the tax deferral. The key on this was that the loan had to be unsecured. If the loan is secured, then you no longer get the tax deferral. So that's what we have constructed. So let's go back to the case study that I started with earlier. If you remember, we had the net sales proceeds of 6.1 million. Out of that 6.1, we have a repayment of the loan, and then we have net before taxes, the taxes, and then net after taxes. So as far as my client, if they paid off the loan and they paid all their taxes, they would end up with $3 million. That's what they would net out of that 6.1 is $3 million. Now, using our program, the same 6.1 million, our program fees, our program does cost 6.5%. So those are the program fees that have to get paid. We do have to refinance that debt. So we have to pay off that debt and clear it. And that also releases the asset for the buyer. So they end up with 4.853. So they end up with almost $1.8 million more that they get to use now and not pay taxes for 30 years. Okay, so this is one way to get liquid, stay on the sidelines until April to June next year when all of the opportunities come out. In addition, this works with if you're in a deal with people that you don't want to go into the next deal with. So an example of this is I worked with a client that had 3 siblings. Dad left them a property in San Francisco that was about a $9 million property. 2 of the 3 siblings did want to do 1031 exchanges. The 3rd sibling was a teacher, and he did not want to go into real estate. He just wanted to put the money into a fund. He wanted to get a straight fixed income. And so we were able to separate the 3 parties, giving 1031 for the 2 and cash for the 3rd. Another method that we've used this is I have one client that has multiple properties, let's say in Ohio. He has sold probably about 6 of these properties, put all them together into one loan and liquidated his portfolio so that he is ready to move forward when the market changes. Okay, so I also have a tax incentive that works for people who just want to pay the taxes and be done with it. And this is usually people who think, you know, I'm not going to be here in 30 years. I don't want to try and explain this to my children. I don't want to leave a burden for them to have to pay the taxes after I'm gone. So we have a special incentive program that I can't really explain on tonight's event, but it's a personal program that I would have to explain to each of you understanding your scenarios. But essentially, what we do is you are paying a straight flat rate 15% tax. So 30 to 44, 45% or 15. Obviously 15% to be done, not have to worry about it, also has some benefits. So how does that compare to the program where you're only paying 6.5%? Essentially, you know, you'd get almost $400,000 more by not paying the taxes. So you'd have to look at your individual scenario to see if the hassle factor, and there's not a lot of hassle, but some people think it's a hassle factor, of paying the taxes down the road is worth the extra money. So I'm going to go through some important questions, and then I'll give you some information at the end. If this is something that you think you want to do, you'll have contact info, but it's important that we talk before you receive your sales proceeds, because the minute you receive your sales proceeds, I'm not going to be able to help you with this. Okay, so people will say, well, why would the IRS allow this? Well, not only do they allow it, in 2020, they wrote a memorandum in support of it. And the reason is it creates commerce. You know, the money that you're getting in your pocket, the extra 300,000 or 400,000 or $1.7 million, you're putting into the economy, creating more commerce, which they can tax more. And they're really not even saying you're not paying the taxes, you're just kicking the bucket down the road. So one of the big questions, what happens if the dealer does not make the payments? It's very important to understand it's unsecured and non-recourse. So those two words mean that you have no risk. If the dealer doesn't make the payments, you're not on the hook for it. The lender is not looking to you as the seller for this loan. The lender has a relationship with the capital asset dealer. They know that dealer's history in investing, and they're making the loan trusting that that dealer is going to make the payments, not that you're going to make the payments. So why would a dealer do this? I'm sorry, why would a lender do this? Why would somebody go unsecured? Well, the best way to explain this or give you a picture is think of pension funds. Pension funds have got so much money that they need to deploy and have a good, safe, long-term return on, that they can't get into a lot of the investments that we as smaller investors can get into. So by using this system with the capital asset dealer, they construct a 6% return for 30 years on a large amount of capital. And the lender that does this is part of a commercial lender. So it's a large commercial lender. I'm not at liberty to tell you who it is, but they created an affiliate that created a private lender. So we've had companies, you know, like a data warehouse, $50 million, and all their attorneys go through this and they still did it. We've worked with, you know, 10, 15, 21 million. The key is that your sales price has to be 500,000 or more, or if you put more than 2 properties together or 3 properties together to get to that sales price, that's another way to make that happen. So as I mentioned before, some people, you know, just want to pay the taxes because they don't want to leave a burden for their children or their estate. The question comes up, what happens if I die before my 30 years are up? Well, we have the automatic escrow set up. So all the money transfers automatically, whether you're alive or not. And all of that transfers into your estate. So it just continues to go. You have the tax deferral until that 360th payment comes up. When that 360th payment comes up, it transfers to your escrow account, which is actually now your estate's escrow account, and then it pays off the loan. In the next tax year, your estate owes taxes on that gain. Now the gain is locked in now. So if you have $1 million gain now, your gain is still $1 million in 30 years. What's the tax rate going to be in 30 years? We don't know. So some people say they would rather pay the 15% tax now. Some people say, even if I had to pay 100%, if I had to pay the whole $1 million, having that money now, I can make it grow and make it worthwhile to take that risk down the road. Another thought is, when it gets into the estate, what if there's no money left in the estate to pay the taxes? What happens? Nothing. There's no money in the estate to pay the taxes. It does not transfer to the heirs unless they received something from the estate. So it's all about tax planning. You have 30 years to plan how these taxes are going to be paid, and you get to use the money until that point. Okay, so we talked about a lot of things. I want to just address this last one. Why is carryover basis a bad thing? And let me explain what this means. Let's say you have one asset and you 1031 into your next asset. You're taking the basis or the price that you purchased that one into your next. And if you own that one for 10 years, now that transfers over, and most depreciation is anywhere from 27.5 to 39 years. So you're already cutting down how long you can depreciate your asset. Now, depreciation is a benefit to you. When you have depreciation, it is a non-real expense. Basically, you get to shelter income with depreciation. And the amount of income you shelter can be anywhere from 10 to 50%. So here's an example of one of my clients. In 2001, they purchased a property for $450,000. They sold it in 2019 for 1.8. That means they owned it for 18 years. 2019, they wanted to purchase a new property for $3 million. So the way depreciation works, 3 million minus the 1.8, they get 1.2 for 9.5 years. Why is it only 9.5 years? Because the other asset they owned for 18. Combining those gives you the 27.5. The remaining can go for another 18 years. So if we add it all up, they got depreciation of $948,000 if they did a 1031. But by using our program, they were able to buy the new asset with cash and leverage. Now they get the full depreciation of $76,000 on the full 27 years, which comes out to $2.1 million. So they get to offset income by $1.1 million more by paying cash for the asset now. If you assume that you're in a 30% tax bracket, that 1.1 million at 30%, that means that you've just sheltered another $345,000 in taxes just by leaving the depreciation there, by paying cash for the asset instead of doing a 1031. And if you remember, by sticking that $300,000 at 8% compounding for 30 years, that's $3 million that you could be leaving on the table by doing a 1031 instead of doing a cash purchase. So the strategies that we use at the highest level of explanation simply are trading your taxable sales proceeds for non-taxable loan proceeds. That's what we're doing, is we're just trading those. And we're doing that for 30 years. This is a done-for-you system. You don't have to figure anything out. It's proven. It's been around for many years. We've done, I don't know, in my personal history, I've seen at least 15 of these transactions done, anywhere from 500,000 up to 50 million. And it's really simple. There's one key piece. and I think I mentioned it before, this must be set up before the funds come to escrow. So basically, I say before going to the accommodator. When you have a title company, the money goes to the title company, and then it gets transferred over to a qualified intermediary or accommodator. Not all the accommodators will allow you to do installment sales. And so it's important to work with the right accommodator that will allow you to do that. And we do have those resources. We also have attorneys and CPAs that have vetted this, reviewed it, represented it, and it has also been through multiple audits and passed without any issues. So it's what you keep that matters. This is how you can reach me if you have any questions. And I don't know, Karin, are we going to do some questions live, or how do you want to do that?
We absolutely can. I know that
we lost you.
I am muted. No, I'm not. No,
yes.
we could absolutely take some questions. I know we had a couple advanced.
Oh, we lost you again.
That even happened. Am I back?
You're back now. Yes.
I'm okay. Hi.
Hi.
You guys, if you've got questions for Lori, and this kind of blew my mind. I didn't really, this is amazing. So if you guys have questions for Lori, why don't you type them in the chat box right now, and then we can get to them. I mean, I know Alan Pollack said on the step-up depreciation, they get the step-up for buying more than the sale. Can you address Alan's question?
I'm not sure I understand the question. Is that a question or a comment?
Well, let's see. Let's have Alan specify, if he will. Do you want to? He's not doing that. But Lori, how did you come upon this scenario, or upon this?
Well, okay, so running the San Jose REIA, it was presented to me because I have some development projects that we add a lot of value to. Mm-hmm. And I just, I was trying to find some different strategies. I'd looked at DSTs, and I thought, okay, I could do that.
By the way, that's a Delaware statutory trust, you're saying, just.
Yes.
Yeah.
Yes, there's both of them. I'm sorry, Delaware statutory trust and deferred sales trust. I looked at both of those, and it was great as long as the money went to where they wanted it to. But if I wanted the money, I didn't really have it with me to direct it the way I wanted without paying taxes. And so when I found this method, it fit all of the needs that we were looking at.
So we've got a question from Benjamin Smith. He wants to know, how long does it take to get this all put together?
So once your property has closed, the money is sitting with escrow, it transfers to our 1031 accommodator, and it takes about 7 days after you have signed all of your documents for it to happen. It happens through an escrow company. So your sales proceeds are in an escrow company, the loan proceeds come to an escrow, the instructions say only release when everything is in. So it's very safe.
Okay, Sam Greer has a question. He says, in the event that the heirs receive something from the estate, they become responsible for the entire tax bill at 30. And that's a question. So
that is, it's not necessarily the full tax bill, but whatever they receive. So if they received $500,000 out of the estate and the tax bill is $500,000, they have to pay the whole tax bill. If they received $500,000 and the tax bill is $300,000, they would have to pay the $300,000. You can't get the money without owing the money. But if, let's say that they receive nothing, the estate has nothing, then there's nothing.
Yeah. Sam said, thank you. So that's awesome. That's awesome. That's great. So what are some recent scenarios that you've seen where this has really benefited people?
Yeah, so I work with a lot of different clients. So most of my clients are real estate investors. A lot of them have purchased properties, added value, held them for more than 13 months, which makes them a long-term asset, so they're able to get out of them. And I don't know if you're part of a syndication or you do syndications. This is great for those who are in syndications because they don't necessarily want to take everybody who's in that syndication into the next property. So they can cash everybody out, give them 30-year deferrals, and take whatever money they want and go into a new deal and not have to take all the same people into a 1031.
Awesome. Alan Pollock is asking, can you split the sale to a 1031 and then the installment?
Yes, so what we do is we have it set up with our 1031 accommodator. What that does is that essentially gives you 180 days to decide how you want to do this. If you want some of it to be monetized installment sale, you want some of it to be 1031. You can split it however you want. At day 45, you still need to identify properties to keep your 1031 intact. And then you need to have everything complete by 180 days. Now, one of the things that you might find if you go out researching this is that the state of California issued a statement saying that a defaulted 1031 cannot do a monetized installment sale. That's correct. If you defaulted on a 1031, you now have constructive receipt. Nothing can save a defaulted 1031 except opportunity zone. Okay, opportunity zone, you can place the gain into an opportunity zone fund after a defaulted 1031. But what we're doing is not defaulting on a 1031. We're giving our clients the option, 1031 or monetized or both.
Robert D puts a little comment in there. He'd love to talk to you. So okay. We'll make sure, make sure that, Robert, that you reach out to Lori. Her contact information is here. And, OC, we're not here to sell something. We're here to teach you. And this is, I've certainly learned a lot tonight. I've never even heard of this. So this is great. I think we've all learned a lot. I've seen a lot of messages here. I think that Omar says he's currently syndicated an apartment deal in Texas. In the future, he's going to share this with his investors, he says. So that's awesome.
Perfect. Yes.
Great. And so Christy is asking, is it a minimum $500,000 sale proceeds or sale price?
Sale proceeds.
Proceeds. Okay.
Yes.
Good to know.
So if the sales, let's say the sales price is 500 and then you have to pay your commissions and it's less. I actually have a vendor that will do something if it's close. But if you're at 150,000, it's just not worth it for you or them because your gain's not going to be big enough.
Awesome. And so Lori, how can we can connect with you in so many ways? I know you're all over social media, right? We can,
yes.
LinkedIn, I know you're on LinkedIn, so that's a great way to connect with you too, besides emailing.
Yeah, so the callwithlori.com, that is my calendar. So you can just book a consult right there on my calendar. And we can talk about your personal situation. If you want to share with me, what you're thinking of doing, I can run it through my little calculator and show you the difference between, what you would do if you paid taxes, if you did the 15% tax and just we're done with it, or want to do the 6.5 program. Awesome.
Fantastic. Okay, great, everybody. Hey, thanks for being here tonight. If you have any questions, so you guys can both unmute your mics there. And so the more socially conscious we can be with our investing and the more we're doing win-win sorts of deals like Lori's talking about, it's just, and like you're talking about, it just gives a better name to real estate investors and it helps everyone. We all benefit. Okay, here's a question from Soledad Garcia. She says, can the seller buy a property with the funds received, this is for Lori, and buy a home and move into it, or must it be strictly invested?
Okay, so the idea is that we are giving you a business loan. So the reason we're doing a business loan is it offsets the interest income. And so technically it should be a business asset. If you can make your particular house that you're buying a business asset, then you can maybe make it work. But that's the technicalities of it.
Okay, all right. I want to remind you too that this entire presentation tonight has been recorded. And so everybody who registered, by tomorrow morning, you will be receiving an email with a link to this presentation in your inbox. If you don't see it, check your spam in case it went there, but I'm going to send that to you. And so one more question, Sam Greer says, do you see multifamily holding their price per unit or reducing them in the near future? Now, that could be a Kathleen question, that could be a Lori question. So Kathleen, why don't you take a stab at it? We'll let Lori take a stab at it too. You're muted, Kathleen. There we go.
Thanks, Karen. Sorry about that. So as we know in multifamily and commercial, the price or the value of a property is based off of that net operating income. So really the value of the property in the future is going to depend on what is the income of that property and the expenses of the property. And do you have higher vacancies? Do you have to offer rent concessions because of vacancies or because the market has shifted? So I think that the issue that we're seeing with the rents currently, and I can't promise you what's going to happen in the future, but the current issue is really in that lower level of apartments or lower level rent strata. So B minus C properties. I would think that we are going to have some vacancy, and we are going to have some concessions. Now, we're already seeing that kind of thing in New York, in the big cities, in New York and San Francisco. So, so I think that it's starting in certain markets, but I don't think you can really make a blanket statement about all of real estate or all of multifamily. I think it's really a case-by-case, city-by-city, location driven response that I would have to that. But remember, multifamily is really priced based off a cap rate and based off of that net operating income, which may be a topic for a whole nother day on how to calculate those things, but happy to go through that with you in the future.
And Lori, do you want to chime in on where you see multi-family holding their the price per unit? Or do you think that will be reduced?
I think that, I don't know that we're going to see anything greatly reduced, but I do think that we are going to see things soften whenever you run up against people who don't have good reserves, you know, tenants, all that. I think that it's definitely going to come down. I don't think it's going to come down anything like 30–40%, but I think you can say 10 to 15% is pretty realistic.
Thanks so much. Good night.
Okay.